Good morning, everyone. Welcome back to Morning Markets from the team at True Potential. Today, we'll just look back at some of the performance of asset markets yesterday and think about some of the trends that we've been seeing. So, with current sentiment in markets, it was probably not surprising yesterday to see just the major equity markets in Europe and the US primarily just trade sideways over the course of the day. So, to give you some context there, if we look at the Euro Stoxx 600, it was down about 10 basis points over the course of the day. In the US, the S&P 500 was pretty much unchanged. The Nasdaq a little bit better, up about 30 basis points. And similar moves to in Asia over that overnight as well, where we'd seen equity markets up about 0.3%. The one market that probably does catch a little bit of attention is just the weakness of the UK large cap market. In that sense, it was down about 70 basis points in the day. That's probably just a function of what happened with sterling. Sterling strength is typically a negative for the FTSE, and I'll come on and discuss that in just a moment or two. But within that, and looking at the composition of how individual sectors moved within asset markets and equity markets in particular, it was still those that are more sensitive to the economic recovery that continue to provide a good performance. So by that I mean energy, materials, some of the consumer discretionary names, financials, and indeed small and mid-cap areas of the market all continued to outperform those broader index levels that I've just mentioned. And that just, I suppose, is the balance between trying to look through the current situation as to where we are with COVID-19, rising infection rates, hospitalizations, and the lockdown measures that we see, and the ongoing discussion of extending lockdown measures. Just looking at yesterday, we had some commentary from Germany that was suggesting that they might look to extend measures through to Easter, so an additional 10 weeks. But then we've got the other side of that. We've got the expectation of the rollout of vaccines, the acceleration of that, the further fiscal support packages that are likely to come in the US, and the support that will bring to the current economic situation, but also to further economic growth into the future. Well, the trend that we have been discussing and has continued to be evident is that within the sovereign bond market, and indeed it continued to be for prices to weaken there. Although just this morning, looking at how the US 10-year performed yesterday, we did see it move out quite materially to 1.17% on the yield there. But then over the course of the day, that did come in, closing unchanged at 1.13%. I think that's instructive because the move back did coincide with a US Treasury auction for US 10-year Treasuries of close to $40 billion. And I suppose one of the things to think about there, a weaker price makes that more attractive, so a higher yield makes it more attractive for investors. And that's what we did see yesterday. We saw investors coming in, and whilst the market price was out at 1.17, the Treasury was able to sell that bond at 1.16, and that did give a bit of support to the market, and then saw the market trade in over the rest of the day. And that'll be something that we'll have to continue to monitor through the next number of months, and indeed over the year, in terms of the Treasury's actions, how that's funding activity, also what market demand is, and by inference then, is there any requirement for the Federal Reserve to do more in terms of their quantitative easing programme. I think the other thing just to touch on, we mentioned this last week, was the surprising move within OPEC and OPEC Plus for OPEC, and particularly Saudi Arabia, to reduce its quota, and for Russia to step up and pump a little bit more oil into the market, but maintaining the overall quota level. We've seen that support oil prices, and Brent crude has traded back above $56 a barrel. Just casting our minds back to March and April time of last year, that's a very step change in where the oil price is, and something that will, over the next number of months, feed into inflation. But we'll just have to monitor how that goes. I think the near term will be very much around balancing that supply quota that OPEC and OPEC Plus have versus the demand environment, which given the lockdown measures, it may, over the short term, influence the demand for oil and oil derivatives. So we'll see how that plays out over the next number of weeks and indeed months, but it does appear that there is some support to the oil price at this point in time. The other point, just to really mention, I touched on it right at the start about the performance of the FTSE. Sterling did strengthen about 1% yesterday against the dollar, and that very much came through as the Bank of England Governor Andrew Bailey gave some views around negative interest rates, and I think he did temper sort of the expectation of where they are, citing that there are lots of issues to consider in the use of negative interest rates, and that really does contrast with the report and the speech that I mentioned yesterday, and just shows the level of disagreement or debate, I suppose a healthy debate actually, within the Bank of England and the MPC at this point in time around the use of negative rates. Just then, looking to the day ahead, we've got industrial production numbers coming out of the Eurozone, and also we'll get an inflation print from the US, which will give us an indication to think about how inflation is evolving as in reality versus the market implied expectations that we know have touched up to around 2.1% over the past number of weeks. That's it for today. Please do subscribe on our YouTube channel. Many thanks.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.